Silver and gold aren't simply moving today, they're making an entrance, and if you've spent any real time watching this space, you can sense it. There's a deeper shift happening beneath the price charts, beneath the headlines, beneath the so-called experts who keep insisting this rally has run out of steam. Because here's the reality we're dealing with right now. Within the same 24-hour window, we're seeing new signals coming out of Japan, fresh developments out of China, a jolt from Hong Kong, and a direct operational warning from one of the largest bullion operations on Earth. When you place these stories side by side, they don't feel random. They form a pattern. So in this video, I'm going to walk you through what that pattern actually is, what it could mean for silver and gold as we move into the next phase, why so many people are still behind this move, and what signals to watch so you're not caught reacting after the fact. Yes, we'll talk about prices, but more importantly, we'll talk about why those prices are behaving the way they are. Before we dive in, a quick note. I'm running a pushback campaign against recycled copy-paste content that keeps getting reposted. That only works if the real community shows up. If you value what we do here, hit subscribe and drop a quick comment that says RJAG so the algorithm knows this channel deserves protection. Also, check the description after the video. I've added bonus links there, including access to the premium WhatsApp channel and the channel membership if you want deeper research and extra material. Now let's get straight into it. Because the first clue is showing up in a place most people aren't even looking. It's a live price snapshot kind of clue, the kind you only catch when you compare the paper narrative to what's happening in the real world. Today, silver and gold are sending a message that's easy to miss if you only glance at a chart. When markets are calm, prices can drift sideways for weeks, and everyone can pretend everything is fine. But when stress enters the system, the small details start shouting. One of those details is the relationship between the spot price and the futures price. When the immediate, right now price starts showing more strength than the forward price, that's not just a quirky technical detail. That's the market telling you the metal is wanted now. And in the world of precious metals, wanted now is a serious statement. You'll hear people casually throw around words like contango and backwardation as if they're just textbook definitions. But traders care about them for one simple reason. They reveal urgency. They show whether the market feels comfortable about supply and delivery or whether anxiety is creeping in. That matters because silver isn't a market where you can instantly ramp up supply. It's a market where everything looks plentiful, right up until someone has to deliver. I'm not here to promise you a specific price by a specific date like a late-night infomercial, but I will tell you something that history keeps confirming. Signals like these tend to appear before major moves, not after. They're early warning lights. And while that's happening, the second clue is even louder. The East is pricing metal differently than the West. This is where things start getting uncomfortable for the old system. For decades, the world acted as if the official price was whatever the paper market said it was, but the physical market doesn't care about spreadsheets. It cares about what's actually available, how quickly it can be delivered, and what it costs to pull it out of circulation. So when you see persistent premiums in major physical hubs, that's not trivia. That's price discovery shifting. That's the market saying we're done negotiating with the paper narrative. And that's why China matters. Not because it sounds dramatic, but because of scale. Scale of buyers, scale of manufacturing, scale of industrial demand, scale of capital that can move when policy changes. The West has been conditioned to think of precious metals as a niche interest, a hobby for those people. But when industrial demand, household demand, and institutional demand start moving together, it stops being niche. It becomes infrastructure. While people argue online about whether silver is overbought, the more important question is this. What if silver isn't overbought at all? What if it's simply been underpriced for years and is now being forced to catch up? That would explain why each pullback doesn't feel like a collapse. It feels like a reset, a shakeout, a cleansing move designed to throw weak hands off the ship while the underlying pressure keeps building. This is exactly where mainstream narratives start acting strange. When prices rise, the script is always the same. First, they ignore it, then they mock it, then they explain why it's temporary. And then, right when it becomes undeniable, they suddenly find reasons to be afraid. They'll warn that the rally is over, they'll claim the top is in, they'll insist smart money is leaving. Meanwhile, quietly, physical metal continues to tighten. So let's zoom out and look at the two biggest forces pushing this entire move forward. Daily headlines matter, yes, but the macro environment is the engine. The first macro force is geopolitical fragmentation. You can feel it everywhere. Trade is no longer just trade, it's leverage. Currency isn't just currency, it's a weapon. Supply chains aren't just logistics anymore, they're national security. In that kind of environment, trust becomes the scarcest commodity of all. And when trust becomes scarce, assets that don't depend on trust suddenly look very attractive. That's why gold has survived countless regimes throughout history, and that's why silver, when supply tightens, can move like wildfire. Silver is both money and material. It's a strategic metal hiding behind a precious label. The second macro force is financial stress, specifically stress in the bond market. This is where many people still get confused, so let me say it clearly. Rising bond yields aren't always good news. Often, they signal that investors are demanding higher returns because they're getting uncomfortable. When bond prices fall, someone is selling, not because they feel relaxed, but because they want out, need liquidity, or are being forced to adjust risk. So when you see bond volatility increasing while metals are rising, that's not coincidence. That's the menu shrinking. For years, investors followed a simple playbook. Stocks went up, bonds protected portfolios, cash felt safe. That playbook worked so well it made people complacent. It convinced them there would always be a bid under everything. But when stocks wobble, bonds wobble, and currencies wobble at the same time, that playbook breaks. And when it breaks, people go looking for a new one. That search is happening right now. Now let's talk about Japan, because Japan is a perfect case study in what happens when a system lives on low rates for so long it becomes addicted. Japan's bond market has acted as a global anchor for decades. It funded carry trades. It served as a stable base. But stability isn't the same thing as strength. Sometimes stability is just delayed consequence. When yields start rising in a meaningful way, the math changes, the risk changes, capital flows shift. And if the carry trade starts to unwind, it doesn't unwind gently, it unwinds like a crowded exit. Here's the key point. When massive pools of capital are forced to reassess bond risk, they don't just rotate from one bond to another, they start asking a deeper question. What do I own that isn't someone else's promise? Gold isn't a promise. Silver isn't a promise. They don't rely on central banks behaving perfectly. So Japan isn't just a Japan story, it's a preview of what happens when the bond world has to relearn fear. At the same time, we're seeing stock market weakness while metals remain resilient. That matters. In past risk-off moments, metals often sold off with everything else as investors rushed to cash. But when metals hold firm while equities sag, it suggests rotation, not panic. It suggests capital is choosing, and that choice grows stronger as safe options disappear. Real estate has its own risks. Crypto is volatile. Stocks can be stretched. Bonds can wobble. Cash can be diluted. When every option looks flawed, people start turning to the corner of the room they ignored for years. That corner is metals. This is where the law of small numbers works in your favor. If allocations to metals are tiny, even a modest shift can have an outsized impact on price. You don't need everyone to buy silver. You don't even need a majority. You need a sufficiently large minority entering a market that's already tight. Now let's bring in the institutional angle, because this is where things can accelerate faster than most expect. In wealthy portfolios and family offices, metals allocations are often shockingly small. When an outlier appears, it's worth paying attention, not because wealthy people are always right, but because they operate with information, advisors, and frameworks most people never see. So when a billionaire in Hong Kong allocates a significant portion of personal wealth into gold, that's not a vanity move. That's not a cute hedge. That's a worldview. It says, I don't like where paper is headed. And when you compare that to how little most large pools have in metals, the implication becomes clear. The gap between underallocated and normal is massive. The gap between normal and defensive is even larger. So the real question isn't whether gold is too high. The real question is how underallocated the world still is, because underallocation plus fear equals urgency, and urgency in a tight market doesn't negotiate. That brings us back to Hong Kong, where you can often see human price discovery before the rest of the world acknowledges it. Charts are useful, but nothing beats watching people physically line up for metal. When lines form, the story has moved from theory to behavior. The paper price stops being the only price that matters. When major dealers sell out quickly, it doesn't mean the world ends tomorrow. It means buyer psychology is shifting. People are choosing to hold the asset itself, not just exposure to the idea of it. In calm times, paper claims are fine. In stressed times, people want the thing. Let me pause here and ask you something, because your answer shapes future videos. Do you think this is mainly an investor-driven story, or is it turning into an industrial shortage story? Drop investor or industrial in the comments. And while you're there, if you've had a real win in your life, business, investing, or personal, share it. It helps lift people who are still building. Now let's talk about something that's been quietly escalating. Major bullion businesses feeling strain. When large dealers change minimum order sizes, adjust service levels, or issue public notes about record volume, that's not marketing fluff. That's operational stress. It means demand is strong enough to force uncomfortable decisions. When the biggest players start signaling strain, it's a reminder that physical markets have limits. Inventory can look plentiful until it isn't. Paper contracts can be created endlessly. Physical metal cannot. When physical demand rises, the entire system gets tested. It can handle a lot, but it can't handle everyone waking up at once. So let's connect the dots. We have price strength, urgency signals, east-west pricing differences, Japan bond stress, equity weakness, billionaire allocation signals, dealer strain. That doesn't look like a tired top. It looks like a transition, a regime shift, the moment when the story moves from enthusiasts to serious capital. If that's true, the next question is what accelerates it. Markets don't need 1,000 reasons, just one catalyst at the wrong time. That catalyst could be policy, a bond event, currency volatility, an industrial supply surprise, or simple momentum pulling in those who've ignored it. Early in major moves, assets get mocked. In the middle, people regret. In the late stage, they chase. We're not in the chase phase yet. You can tell because metals are still treated like a niche. But the cracks are spreading. One overlooked concept here is structural deficit. If silver consumption exceeds production year after year, that gap has to be filled by inventories. Inventories are a buffer. When the buffer shrinks, sensitivity rises. Tight markets don't move smoothly, they move suddenly. That's why signals like spot strength versus futures, rising premiums, record volumes, and operational strain matter. They often show up when the buffer is under pressure. There's also a psychological trap I want to call out. If the price is higher than last year, it must be too late. That's not analysis, that's emotion. Prices can be higher than last year and still early in a secular move. Bull markets move in waves, shaking people out before continuing. The smarter approach is watching whether the drivers are strengthening or weakening. Right now, they're strengthening. This ties into the 2% problem. If only a tiny percentage of large portfolios are in metals, metals aren't priced for mainstream participation. They're priced for a niche. If that niche becomes broader, pricing must adjust. And it won't adjust gently if the physical side is already tight. Market cap comparisons matter for this reason. When massive equities dominate global value, it highlights how much capital is sitting in confidence-based assets. If even a small fraction of that capital wants insurance, a much smaller market can be overwhelmed quickly. Before we move on, a quick creative detour. If you like learning from real stories rather than just charts, there's a link in the description to another channel focused on silver-related success stories. It's motivating to see what consistency can do. Now let's talk about how fast sentiment can flip. For years, silver holders were mocked, dismissed, labeled everything under the sun. Mockery is cheap. But when the people who mocked you suddenly want the same thing at the same time, markets get disorderly. Late arrivals don't arrive calmly, they arrive emotionally, and emotional buying creates vertical moves. I'm not telling you to be reckless, I'm not your advisor, but you need to understand the structure of this market. Silver isn't infinite, supply is constrained, demand is diverse, inventories matter. If demand rises faster than supply, balance has to be restored, usually through price. That's not drama, that's economics. There's also the possibility of new investment channels opening demand. Retirement accounts, managed funds, expanded access, all of that represents potential demand. Even small allocations matter in tight markets. Then there's tokenization backed by real metal. You don't have to love technology to understand the implication. If people can hold metal-backed units frictionlessly, it could pull in demand that never would have bought coins or bars. Not guaranteed, but possible. And in tight markets, possibilities matter. So why does it feel like things are accelerating now? Because confirmations are stacking. Price action, physical behavior, macro stress, institutional signals. When confirmations stack, confidence grows. Gold and silver are related but different. Gold is the monetary anchor. Silver is the hybrid. Gold moves like money. Silver moves like money and like a strategic commodity. That's why silver can lag, then sprint, dip, then launch. Gold often leads. Silver often follows with more force. That's why people watch the ratio, not because it's magical, but because it reflects relative value. When silver is cheap relative to gold, catch-up moves can be violent. A perfect storm doesn't mean certainty. It means conditions favor a direction. Right now, those conditions include geopolitical uncertainty, bond stress, currency pressure, industrial demand, physical tightness, and institutional underallocation. That's the storm. Structural storms don't end because a chart looks overbought for a week. They end when drivers reverse or equilibrium is restored. I don't see clean reversals yet. So what should you watch next? Watch bond behavior, not headlines. Watch yields, volatility, auctions. Watch physical premiums. Watch dealer supply changes. Watch how metals behave on equity down days. Watch institutional language. Words change before allocations. Quick question, which do you think is the biggest driver this year? Japan's bonds, China's pricing, or Western underallocation? Drop Japan, China, or allocation below. Now, about squeeze narratives. They're tempting, but real dislocations are messy. They involve volatility. Respect that. Don't replace risk management with hype. Operational reality matters. Rising silver demand stresses dealers, mints, logistics, production. Bottlenecks create delays. Delays create urgency. Urgency feeds demand. Feedback loops form. There's also a psychological layer, trust in narratives. When official stories clash with lived experience, people seek alternatives. Gold and silver aren't just assets. They're symbols of opting out. That symbolism matters. Miners can offer leverage but carry risk. Physical metal is the foundation. This rally may still be early. Allocations are small. Coverage is dismissive. Public participation is limited. Bond stress persists. Fragmentation persists. Physical signals persist. The story isn't finished. Positioning matters more than perfect timing. Exposure to long-term drivers beats chasing every wiggle. Check the description for bonus links, including the premium WhatsApp and membership. Member-only videos go deeper and are built separately for those who want extra depth. Every major move has a moment when the mocked asset becomes the needed asset. When that realization hits, price reflects regret. Regret drives chasing. Currencies are under pressure globally. Hard assets reprice in response. That's math and psychology. If the East continues setting physical prices, paper pricing loses authority. That's not collapse. It's a shift. And shifts change markets permanently. So what happens next? Consolidation with firm premiums, then another leg higher, or a pullback that shakes weak hands before the next run? Drop one or two and tell me why. Stay ahead by watching signals, not headlines. This isn't about fear, it's about awareness. If you found value here, subscribe. Like the video if you want more gold and silver coverage. Tell me whether you want more macro, physical, or both. Keep your eyes open, your mind calm, and your strategy honest. We're living through a period people will later call obvious, but right now it never is. Take care of yourselves, take care of each other.